Hello, everyone. My name is Greg Phelps, and I wanted to thank you for checking out today's webinar, 12 Tactics That Could, Should, Would, and Hopefully Will add 1.57 to 2.99% per year to your retirement, investment, and financial planning. My very first question to you today is, what if, through these tactics I'm going to discuss, what if I could add that 1.57% to about 3% per year to your investment and retirement planning? Would that be worth the next, let's just say 30 to 45 minutes of your life? My gut tells me you're here for a reason. My gut tells me yes. So that's exactly what I'm going to do today. But I don't want you to take my word for it. These aren't my numbers, 1.57 to 3%. These are numbers that come from Morningstar. These are numbers that come from Vanguard. Industry behemoths, well-respected, highly reputable. They are their research reports, not mine. I am here to just tell you what they said, and hopefully you can implement these things in your own financial plan or find a competent professional planner that can do that for you. So let's go ahead and talk a little bit about who am I. My name is Greg Phelps. I'm the president of Red Rock Wealth Management here in Las Vegas, Nevada. My blog, RetireWire, you can Google that. That's where I put out a lot of my educational content, social media stuff. But Red Rock Wealth Management and RetireWire work hand in hand together. I'm not going to bore you with my whole background. It's a lot of letters, a certified financial planner, accredited investment fiduciary, blah, blah, blah. It's boring stuff. I'll just tell you that I've been doing this for about 25 years now. And suffice to say, as I've worked with some of the biggest companies in the industry, Morgan Stanley, Goldman Sachs, the fourth largest accounting firm in the country, RSM McGladrey. So I've been around the block. I've seen a lot of things. And frankly, that's why I started my own firm in 2005. I got really disgruntled with the whole investment and brokerage industry and being told what was right for my clients by people who didn't know my clients. And so I started Red Rock Wealth Management back in 2005. Additionally, one of the most important things you can know about us, we are very much embracing our fiduciary responsibilities to our clients. And we are one of two firms in town that is actually a CFEX certified fiduciary. The other firm is fantastic as well. You won't go wrong. If we're not the right fit for you, feel free to check them out. But there's about 200 firms worldwide that have achieved this designation. So those are some of the most important things to know. If you really want to know about the letters and the career and stuff, you can go check out my bio, redrockwealth.com, or you can look at the About page on retirewire.com. So that's a bunch of boring stuff. Let's get into the fun stuff. Been a planner for a long time, as I said. I will tell you this. I think that we all approach, or the investing public, we approach financial planning advice and financial planners the wrong way. Most of you who have had a financial advisor or planner, you kind of think along the lines of, well, they just want to sell me an investment product or an insurance product. Or worse yet, they'll take your portfolio and dump you into some outrageous fee, managed portfolio. And then they'll tell you, oh, by the way, you need a mortgage on your house. And they'll sell you a mortgage. I've seen this happen. I've helped clients unwind these things. And then they'll tell you, oh, by the way, if you die, you need a life insurance policy to pay that off. And all the while, they're just laughing all the way to the bank and looking for the next sucker on the way. So you've been ingrained in this Wall Street machine, this massive marketing machine that effectively approaches it as a product is a solution, not a plan is a solution. I want to change the way that you think about financial planning. I want to change the way that you work with a financial planner or you do this on your own. I want to basically kind of reinvent that paradigm so you can improve your retirement plan, so you can get that memorable and purposeful retirement life that you've always dreamed of. And so I'm going to dig right in to some of the meat and potatoes of this right now. Real quickly, a little preface, foundation work here. I fully believe you cannot add alpha. And what I mean by that is, one investment manager over the other investment manager, they don't add any value. It's not as if somebody has some secret sauce. And again, the Wall Street marketing machine has ingrained this in you for decades. Hey, come with us. We'll beat the benchmark. We'll beat the next guy. We'll beat the index. We're the top this and the top that. And the truth is, when it comes to investing, alpha doesn't exist. Alpha is value added. So if your neighbor doesn't have your advisor and he gets 5% a year, they're going to tell you, well, we can get 5.5% a year. That doesn't exist. It does statistically in very small cases by law of mathematics. It has to. The benchmark cannot beat every actively managed fund, but it is not consistent. It is not replicable. It is not something that you can base your retirement dreams off of. So when I talk about alpha in the context of this webinar, I'm actually talking about the value added that you can bring to the table with great financial planning decisions. And yeah, there's some of that investment stuff too that you can also go implement itself. But for the most part, value added that I'm going to be discussing is through great financial planning decisions, and some of that is investment related as well. So let's go ahead and dig right in. Now, I mentioned these aren't my numbers. These numbers are from Morningstar, and these numbers are from Vanguard. So I'm going to break this down real quick because it's an awful lot of information. And if you stick around, by the way, to the end, you will. I'll go ahead and I'll send you the links. You can download the reports. You can read them yourself. You can decide what you can and cannot implement and what you do and don't want to implement, or you can decide if you want somebody to do it all for you. But these are Morningstar and Vanguard reports. So let's talk a little bit about the Morningstar report. So Morningstar broke this down a little bit differently. Morningstar said, hey, we look at these 5 things that you can do as an investor or your financial planner can do for you. And these 5 things, if they're done properly for the right investor, should garner a utility, they say that the utility, mathematical utility of 1.57% per year. So is that going to show up in your investment returns? No, because I already said alpha, some of it might. I already said alpha doesn't really exist. Managers don't really add value in the investment framework. On the financial planning side, they add tremendous value. So it's not necessarily going to show up in your bottom line. Could it show up 5 years down the road when your tax bill is $2,000 instead of $5,000 because you made some really smart financial planning decisions today? Absolutely. Will you tie those 2 things back together and equate them together? Probably not. But these are the types of decisions that add massive value to your retirement lifetime. That $3,000 in less taxes you pay in 5 years could mean an extra trip for you and so forth. So keep that in mind. They're not always tangible, not always quantifiable in the way that you have been told they should be. Wall Street has told you, well, we can get X percent over the next guy. They're not always quantifiable like that, but they are nonetheless equally and frankly way more important because the investment alpha has gone away. And that's with the advent of indexing and so forth. So the Morningstar study, they took these 5 things. They said, hey, if you can do these 5 things, you should be able to add 1.57% in utility to your retirement and investment planning. Let's talk about these 5 things. The very first one that they discuss is asset allocation based on a total wealth framework. And what they mean is the asset allocation decision, that is in the Vanguard study as well. So these 2 things cross over. There's a few of them that do cross over. But what they mean by this is where you put your assets, where you put your investments, how much in stocks versus bonds first, how much in big companies versus small companies, U.S. companies versus international companies, international or emerging market, how much in commodities, how much in real estate, and on and on and on. How much in long-term bonds, short-term bonds, government bonds, corporate bonds, you name it. That's the asset allocation decision. So that is number 1 on the Morningstar list. And they want you, or they say, that by basing it on a total wealth framework, you can improve your results. I'm not going to go into the complexities of how they come up with this number because it is highly complex. Stick around, get the report, read it for yourself. There's several pages at the end with all kinds of crazy equations and mathematics and algebra that will boggle your mind because it boggled my mind, frankly, and I actually like this stuff. But suffice to say, that is number 1, asset allocation based on a total wealth framework. And what they mean by the total wealth framework is you're going to have streams of income in retirement. You're going to have Social Security. You're going to have pension income. And these incomes, they're guaranteed for the rest of your life. So they can, in theory, be included as the present value of them as a bond investment, as a safe investment. Possibly, if you look at it as a total wealth framework, allowing you to invest more of your money into growthier assets because those safe streams of lifetime guaranteed income are there. That's number 1. Number 2, and again, I've got 12 things to go through, and I don't want to bore you for hours. So forgive me if I go a little quick on this, but feel free to reach out and I'll discuss it with you offline. Number 2 is a dynamic withdrawal strategy. So most investors, most retirees, they see the report, they read the report, they say 4% per year. You got $1 million, they're going to take out $40,000 per year, and then they're going to grow that $40,000 with inflation. And that just doesn't cover it. It doesn't cut it. And so what Morningstar has said in the process is basically, hey, you need to consider your withdrawal strategy more dynamically. For example, you're going to be taking out more money earlier on, what I like to call front-loading your retirement. while you're 60 and 65 and 70, and you can travel and you can do stuff with the kids and the grandkids. You're going to front load your retirement. Whereas when you're 75 or 85, you're probably not buying all the new cars. You're probably not doing all the traveling. Life changes, and I've learned this over, working with people, thousands of people over the last few decades, that life changes and your withdrawal strategy isn't fixed. It's not based off of 4%. You need to put this in the context of a very comprehensive retirement plan. And that's what they're saying about number 2, dynamic withdrawal strategy. By basically looking at your assets, expenses, incomes, liabilities projected over the next 2 to 3 decades of your life, you can achieve a better result by planning for those things. And that actually, they say, effectively, actually, I take that back. They put that in the context of the 5 things that give you the 1.57. The third thing, I'm going to preface this, I got to walk lightly here, because we do not sell insurance. We typically avoid insurance and annuities. It's just not what we do. We're a fee-only financial planner, and those products are sold with commissions. So typically we avoid that. However, number 3 in the Morningstar report is guaranteed income sources. And what they're referring to is adding an immediate annuity with a lifetime of payments to your plan. Now, while we don't sell insurance, it is something that we look at. While we don't necessarily recommend annuities, it is something that you should look at in the context of your overall retirement plan. So if you've got the Social Security, you've got the pension income, and you've got this big pool of assets that you've been saving for decades and decades, what if you had $1 million portfolio and you took $200,000 and put it into a guaranteed stream of income for the rest of your life? Does that improve your chances of living the fullest life possible and not dying broke? Does it decrease those chances? Those things need to be looked at. Those things need to be reviewed and illustrated, whether we use them or recommend them or not. So that's number 3 in the Morningstar report. Number 4 is tax-efficient asset allocation and withdrawal sourcing. So when we talk about asset allocation, how much in stocks versus bonds and yada, yada, that's one piece of the puzzle. Number 4, and this is really important, this is something that you can do for yourself if you really want to. Number 4 is, how do you allocate or locate your assets among different types of accounts? This has varying degrees of effect for people. So, for example, if you're a 100% bond investor, this is irrelevant. If you're 100% stock, this is irrelevant. If you have all of your assets into a taxable account or a tax-free account, this is irrelevant. But for those of you who are more normal, more mainstream, and you've got money in an IRA, money in a taxable account, money into a Roth account, and you've got, let's just say, equal amounts in each of them, and you're a 50-50 investor, these things work fantastically. This strategy works fantastically. So what we're saying is take the least tax-efficient assets, those things that, for example, taxable bonds, and let's go ahead and put those into an account, for example, an IRA that's pre-tax, where you don't necessarily want that much growth there because that's going to be pulled out at ordinary income tax rates. And let's take things that are really tax efficient, like your stock investments, and let's put those over into your taxable accounts where you're going to get taxed at capital gains rates, which are generally going to be lower for pretty much everybody on this call. So that's the asset location decisions. For example, things like commodities, really tax inefficient. That might go with your bonds into your IRAs. And things like your index funds, U.S. index funds, that would probably go into your taxable accounts, because as you pull those money and you do those liquidations, you'll be paying predominantly capital gains rates. Withdrawal sourcing, where you're going to pull the money, is also very, very important, because as you take your portfolio out to live off of through retirement from 65 to 95, let's say, you can take your money from taxable accounts, from pre-tax accounts like an IRA, or from your tax-free accounts, and how you draw those monies out is incredibly important. The conventional wisdom, and this is in the Vanguard study too, so I'll spend more time on it now, is that you're going to spend down your taxable assets first, then you're going to spend down your IRA assets, and finally your tax-free assets. I don't believe it's quite that simple. There are some tax planning strategies you can put into place that go above and beyond these studies that will add far more value. For example, you should be maximizing your tax brackets with your IRA withdrawals, or your Roth conversions. So you can use combinations of these strategies to effectively minimize your lifetime taxes. It's just not in these two reports, but to me, that's probably more important than just the asset location or the withdrawal sourcing question. So finally, number 5 on the Morningstar report is liability relative optimization. What we mean by this is, for example, you're 65 now. Over the next 10 years, you might be spending more money. You might have more trips planned. You might want to buy more new cars. And so those things have specific financial goals tied to them. Those financial goals, they're going to be affected by inflation, possibly currency risk. And so the liability relative optimization effectively says you should consider what your expenses will be over the next 5, 7, 10 years, and possibly create a plan that looks for safer investments to fill those buckets of withdrawals, and everything else would go into sort of a longer term growth type of portfolio. So that would be your liability relative optimization. So now, like I said, Morningstar took these 5 factors. They said, okay, they used a Monte Carlo simulation, which we use in planning all the time, and they figured 20% stock investor, 80% bond. And again, varying allocations and types of accounts and tax brackets are going to give you different results. But they said at that 4% withdrawal rate, you could expect, how did they word it here? Let's say the same impact on expected utility as an annual arithmetic return increase of 1.57%. I know it's mouthy. It's look at the report. You'll see all the equations in the back. But suffice to say, they're not my numbers. It's their study. And so if you can gain that, what they feel is 1.57%, would that change your life? My gut tells me, yeah. My gut tells me whether it's in taxes or certainty equivalent income, or my gut tells me that 1.57% would change your life. Now, is everybody going to get that 1.57%? And the answer is no, because again, everybody's different. But if you get some function of that 1.57, or possibly you get more because you have the optimal scenario, would that change your life? And my gut tells me yes. So now let's move on to the Vanguard study called Quantifying Advisors Alpha. And you can find these, the Morningstar study, they try to decipher advisor gamma is their term for it. Vanguard, they actually try to quantify advisor alpha. And again, this is not alpha on the investment side, it's alpha in terms of the financial planning process and smart decisions. So let's go ahead and go through that study. So Vanguard basically set out and said that asset allocation is the single number one most important factor, plain simple, period. I tend to kind of agree. It is the most important factor. However, I would say equally as important is the actual planning process, because without the planning process, you can't really determine what your asset allocation is. And you know, the Morningstar and the Vanguard study, they talk about, well, asset allocation is typically just risk-based. You know, how much risk can you sleep with? What makes you comfortable or not comfortable in a good or a bad market? And that's really only a part of the equation. The asset allocation decision should be based off of, yes, your risk tolerance to some extent, but also your risk capacity. You know, how much risk could you take? This is a discussion to have. How much risk could you take? And if you had a series of negative events like 2008, would that completely knock you off course with your retirement plan? Conversely, what's your risk required? I mean, you may have goals that are so lofty, you have to take more risk, or you lower your goals. So again, this asset allocation question is so important, but only in the context of your overall retirement plan. And so, you know, Vanguard did this study and they said, hey, if we just took this simple 60-40 portfolio and we went out and we competed against the biggest endowments and the medium endowments and the smallest endowments, how do we fare? How does just a simple 60-40 stock bond portfolio using index funds compete against what we would assume to be the best investors on the planet? These endowment funds, they have access to investments that we don't have. They have the best professional money managers that are hired full-time to manage these things. And what you're seeing here is, if you look at the results, the simple 60-40 portfolio pretty much walloped the small and the medium endowments, and in almost every time period, as you're seeing right here. And then relative to the large endowments, the biggest of the big, they trailed, but not by that much. And so they make a very good case for asset allocation to be the most important decision that you'll make. Number 2 would be a cost-effective implementation. So this is real simple. By saving money on your investments and fees, you're going to have more money at the end of the day. Most people most investors, they're not even aware of what investment fees they're paying, what commissions, what trading costs, how tax efficient are your ETFs, your mutual funds, what is your advisor charging you? Do you know? I'll just ask you that. Do you know what you're paying? Because it's very, very rare that I have anybody walk into the office and they know, oh, I'm paying this and this and this. And the truth is, most advisors are going to put you in more expensive products. And so by moving to a lower cost investment product, more like an index fund, we're big believers in passive investing. It's a whole nother webinar altogether. We typically use what we call a smart beta approach, which is a little bit like indexing on steroids. But the cost to investors is dynamically less. And so in this Vanguard study, they said the average investor pays 0.37% for their bond portfolio. And the average investor pays 0.54% for their stock portfolio. The low-cost investor pays 0.09%, so 9 basis points or 0.09 and that's for bonds, and then pays 0.15 for stocks. So there's a dynamic difference between the average investor and the low-cost investor. Right there, Vanguard is saying, hey, you can add about 40 basis points. By the way, let me backtrack real quick. The asset allocation, because Morningstar said, here's these 5 factors, 1.57% for all of them. Vanguard did it differently. They said, here's 7 factors. They each have varying degrees of value added. On the cost-effective implementation, they came out and said straight up, if you use a low-cost approach to investing, which we wholeheartedly endorse here, that is about 0.40% in value added to your plan, to your portfolio. And that is 40 basis points or nearly 0.5% in another way to look at it. That's a pretty big jump just by an easy switch to lower cost investments. And again, I don't believe there's manager added value in the alpha on the investment side. So this cost effective implementation is pretty easy to do for everybody. You can do this on your own. Number 3, rebalancing. Morningstar did not cover this. It's one of my favorites because it is absolutely wholeheartedly true. Vanguard says straight up 0.35%. So about 1/3 of a point. You can improve your performance just by rebalancing your portfolio. And so what is rebalancing? If the asset allocation decision is number 1 in importance, and I think we can all agree it probably is, if Morningstar is saying it and Vanguard saying it, then the asset rebalancing process is equally as important. So we've already discussed kind of the rebalance or the asset allocation decision, but the rebalancing process is literally as you have assets like large cap stocks, let's say it's 50% of your portfolio, and you wake up in a year and now it's 65%, that's a problem. So you establish a target for that large cap stock allocation. And once it floats above or below that target, you make some trades. You bring your portfolio back into tolerance. And so you're constantly being forced to sell little bits of what's appreciated, what's done well, and buy little bits of what hasn't done well. It's the exact opposite of what most every investor does. They actually will go out and buy what's doing well as it goes up and up and up, and as the value in those investments is lower, and they will sell what didn't do well as it's dropped. So this is the opposite. It's just a different way of thinking, but rebalancing is very, very important. The study in the Vanguard, they literally just talked about annually. So I don't really believe this. I think there's a lot more you can do from rebalancing. Annually is a good place to start. But let's just assume you've got 2 indexes. You got a stock index, and it's 1,000 on January 1st, and you got a bond index, and it's at 1,000 on January 1st. And through June, the stock index goes up to 1,500. You're up 50%. Been a great year. Through June, the bond index dropped to 800. You've lost 20%. Been a bad year in bonds. But you haven't rebalanced yet because it's not that annual time to rebalance. And at the end of the cycle, December 31st, you take a look at your portfolio and you say, hey, I need to rebalance. But what if the stock market came back down and now it's back at 1,000? What if the bond market came back up and now it's at 1,000? And so you missed that entire window of rebalancing. So we believe a little bit more proactive approach by looking at these things. At least, typically we look at these once a month. We don't trade once a month, but we look at these opportunities to say, is it out of tolerance? Can we bring it back in tolerance? It's also important to note that if you have a portfolio that you don't rebalance, and what you're looking at here is just this 60-40 portfolio, 60% stocks, 40% bonds. If you leave it alone and you never rebalance it, what's going to happen in 5 years, 10 years, 20 years down the road? Stocks have a higher long-term expected return. Bonds have a lower long-term expected return, positive but lower. So what you're going to see is your stock portfolio is up and up and up and up, and your bond portfolio is growing, but not as much. And now you've got this disparity. And now you've got far more money into stocks than you originally intended on having. In the Vanguard study that you'll see here, actually what they do is they say, listen, if you're a 60-40 investor, 60% stocks, 40% bonds, and they did this study going back, as you can see here, about 40, 45 years, that 60-40 portfolio with no rebalancing actually exhibited, and I'm sure they used your standard deviation calculations for this, it actually exhibited the risk and the volatility of an 80% stock portfolio. So my question to you, if you want the risk of an 80% stock portfolio, just go out and get an 80% stock portfolio. Or get the 60-40 portfolio, but make sure that it's rebalanced, make sure that it's monitored, managed, and at least on like an annual basis. There is also part of the study that says, hey, by the way, if you don't rebalance, or if you don't rebalance, chances are you're going to have higher returns. It's debatable, but they say that because stocks have a higher expected return. And if you don't rebalance, it means you're probably not selling your stock investments over time. So this is quite possibly true. It's in the study. I'll go ahead and go with it. However, you can look at rebalancing as a risk control measure, meaning that it's maybe not going to add tremendous value on the upside or performance, but it's going to keep your portfolio from getting completely out of whack when you need it to be more concise, more consolidated, more conservative as you enter retirement and as you age. So regardless whether it gives you returns or takes away returns, I've got another study that says it actually added in the last decade a 50-50 portfolio about, it was actually 0.67%, so almost about two-thirds in value added. And if you like that, go ahead and reach out to me and I can email it to you. But whether it takes away or gives you returns, it is a great risk control measure for your portfolio. And again, we're talking mostly for retirees, what you need to focus on. Keep those returns more under control and less crazy by rebalancing them at some interval. Number 4 is behavioral coaching. So behavioral coaching. I've been doing this a long time, so a few decades. I know what you're thinking right now. What's behavioral coaching? It's effectively making sure that you don't make the worst mistake at the worst possible time, that you're not selling to the bottom of 2008, that you're not going crazy and changing your 50-50 allocation to 80% stocks right now when things have been just cruising and the economy's just, killing it. So this is basically saying, let's create a plan. Let's look at your retirement. Where do you want to be? Where are you? How are we going to get you from here to there? And how are we going to do it efficiently and give you maximum confidence? And then once we create that plan, we coach you to stick with it unless there's a real reason to deviate from it. And I'll tell you, a real reason, when we redo your plan, we look at it, we say, hey, are you way ahead of the game? Because we can dial your risk back now. Or, hey, here, let's have a discussion. Let's start you off at this level. And, at some point in time when you're willing to take on more risk and your finances get better, we can do that. Retirement planning, financial plan is dynamic. It's not static. And it is, I can't tell you how many times we'll sit down with a client, come in a couple of times a year, and we'll look at the portfolio and say, by the way, it's time. Let's just take some risk off the table. There's no reason to have all this risk because you can accomplish all your goals. And it just makes sense. But let's talk a little bit about behavioral coaching, because the Dalbar study that you're seeing right now, it makes my point for me. They do this every year. Dalbar is huge. It's very widely accepted. And if you look at 2018, the average investor, stock investor, underperformed the index, the S&P 500, by over 5%. That's insane to me. So you, the average investor, you lost 5% to the S&P 500, which was down about 4, the average investor down about 5. Okay, so 1 year, whatever. Take a look at these numbers going back longer periods of time. When you look at 5-year numbers of the average equity fund versus the S&P 500, the S&P 500 is killing them by more than double. When you look at 10-year numbers, you've got a massive jump from 13% for the S&P to 9.66. There's a massive gap there that you're losing because you're making these mistakes. And 20 years is just as bad. It's even worse when you figure it's compounded over 20 years, but that's almost a 2% difference over 20 years. The same thing goes for your bond investments. So, you can see 5 years, you've got a loss for the average bond investor versus 2.5% for the Barclays aggregate. You've got a barely positive gain over 10 years of 0.7%, 70 basis points, and you've got 3.5 almost for the index. And same thing, when you look at 20 years, you've got barely a break even for the average bond investor and almost a 5% or 4.5% return for the index. So I know what you're thinking. That's not me. I don't make bad decisions like that. I don't worry about the market. It's just not part of what I do investing. And I can tell you, over a few decades now, that very, very few, I don't know that I've had actually anybody, very few, let's say 1% of the people that I've come across can disassociate their emotions from their investment decisions. Maybe 1%. And, it's one of those things. Nobody wants to believe that they're making the bad decisions, but the reality is they are. So Vanguard also did this study of 58,000 self-directed IRAs. And they literally said, okay, so you're 55 years old, we'll put you in this target retirement date fund as our proxy. That's what you're competing against. And what they found is the investors who didn't make transactions in their IRA, they trailed that target date fund by about 20 basis points, 0.19. Not much, and that's to be expected because there's going to be fees and transaction costs. There's going to be other things that are built into those target date funds and the benchmark. But even that's really not that bad because it's very, very close. What they found is that the average investor who actually made one or more transactions in their IRA trailed the target date fund by 1.5%. Now that's huge. If you did nothing else alone, this behavioral coaching is massive. And Vanguard puts a value on it of 1 to 2%. Again, I know you're thinking, that's not me, I don't do that. And that's okay. But the truth is, we all have these tendencies because we're not wired right to be good investors. I wrote a whole chapter on it in my book. And if you want a free copy, just go to Red Rock Wealth. I think scroll down to the bottom. You can get a free copy of it. Vanguard also did a study, and they looked at each different asset class, from big companies to small companies, value, blend, growth, and different allocation models, as you're seeing here. And the difference is it's substantial across the board. It doesn't matter what you're investing in. The average investor can't beat the benchmark index. And that's because they do the wrong thing at the wrong time. Hey, the market's high, let's get on the sideline. Hey, it's going to crash. Hey, it's going to go up, let's leverage up, whatever it is. So number 5, again, that was 1 to 2% that Vanguard put on that. Number 5 is asset location again. And Vanguard again says that the results, it's positive. It's something between 0, I guess it's not positive, but it's something between 0 and 0.75%, 3/4 of 1 point, by taking your least tax efficient investments and putting them in the right tax type of account for that investment. It's a tax play. And again, it's not something that's going to show up in your investment returns because you have the same allocation. That's the best part about asset location. It doesn't add any risk to the equation. But that being said, it is a massive value add. And again, it's more value added if you're in a higher tax bracket versus lower. It's more value added if you have multiple types of accounts, pre-tax, taxable, tax-free. It's more value added if those accounts are relatively similar in size or there's not a huge disparity. And it's more value added if you're more moderate invested versus incredibly aggressive or incredibly conservative. So there's different factors. That's why they say 0 to 0.75. I would have to guess that most of our clients, being retired and moderate investors, have multiple account types. It's probably somewhere in that range of 0.5 point in value added. But just a guesstimate. So 0 to 0.75. Number 6, withdrawal order for client spending. Again, the Morningstar study covered this. The conventional wisdom that you're looking at here is you are always going to take your required minimum distributions from your IRAs first. And that, just so you know, that changed. The new rules, it pushed it back a couple years. I'll do another webinar on that. Stay tuned. But you take your RMDs first, required distributions. Then you're going to take your cash flows from your taxable account, dividends, interest payments, things like that. That's just low-hanging fruit. After that, you would sell off assets in your taxable account, and hopefully you're at capital gains rates on those. You should be. Finally, you're going to take from your tax-deferred accounts. Now, this is where the flow chart gets a little interesting, because if you expect to be in a higher tax bracket later, then you would effectively take your pre-tax dollars first. So your IRAs, pay the taxes now, and then defer off to your Roth IRAs later. If you expect to be in a lower tax bracket, you would take money from your Roth IRAs and so forth. Lower tax bracket later, you would take money from your Roth IRAs first, and then when you're in a lower tax bracket, take it from your pre-tax stuff. So the way that you sequence and the way that you pull your money out in retirement is very, very important to your overall I guess, retirement cash flow spending and so forth. Additionally, as I discussed, it's important to consider Roth conversions in the context of your IRA withdrawals and so forth, because that is a big value add as well. And finally, on the tax withdrawal sequencing or withdrawal sourcing, the conventional wisdom is great, but make sure you're paying special attention to your tax brackets. Make sure you're paying special attention to the IRMA. I would call it a penalty. The more money you make in your or pull out of your IRAs, it could throw you into a higher Medicare premium. So there's a lot of different nuances. That's why it requires a lot of planning and a lot of different scenarios. But that is actually a huge value add. Finally, we're going to talk about number 7 on the Vanguard list, which is total return versus income investing. So most retirement investors have the overwhelming desire, I need cash flow, give me income. And what they'll do is they'll buy longer term bonds, which is what? You have more interest rate risk. A 30-year bond has more interest rate risk than a 5-year bond. So they're riskier. You might get a higher return a little bit, but they're riskier. Or they will get lower quality bonds. So junk bonds, corporate bonds. I want that higher return. I want that cash flow. And they do this, but they're taking more risk. Now you've got credit quality risk. Or what they'll do is they'll say, hey, listen, all these stocks that I have, that's great, but I want these high dividend stocks. I want a 3, a 4, a 5, a 6% dividend, and that'll give my cash flow. But now all of a sudden you're not diversified because you're heavily weighted towards dividend yielding stocks. So they literally say, listen, you need to invest based off of total return. Forget about cash flows and dividends and high interest payments, because those have exceptional risk associated with them, or commensurate risk associated with them. And just focus on total return. Keep in mind that if you have a married couple with $100,000 of income, they're in the 24% marginal bracket right now, right? So they're paying 24% on that higher, that top chunk of income. If they're taking capital gains, they're actually paying 15%. That's the equivalent at that bracket. So I don't know about you, but I would far rather invest for total return versus income, which is mostly going to be ordinary income or high dividends. Some of them are qualified, yes, I know, but your taxable bonds and so forth. So keep that in mind. So those are the 12 tactics. I realize that 2 or 3 of them crossed over. They were presented differently in the reports, but those are 12 tactics that you're going to get the reports, you're going to read it, you're going to look at the equations and the algebra and try to decipher that. That's great. But those are things that can add a lot of value to retirement planning. And at the very least, I hope to get you thinking about these concepts that should be incorporated with your plan. So I'm just going to kind of wrap it up now. And I guess my question to you would be, what if you could get that extra 1.57% or that 3% that Vanguard says? What if you could add that to your bottom line? How would that extra couple of percent or a few percent, whatever you want to call it, how would that change your life? Would you be taking more trips? Would you buy the Mercedes instead of the Toyota? Would you be joining the country club instead of playing the Muni courses? Would you be spending more time with family and grandkids? How would that change your life? It's something to think about. And if you consider the difference between a 5% return, a 6% return, and a 7% return, $1 million retiree or a retiree at 65 with $1 million, that 5% return, if they're living off of 65 grand a year, that's going to last them till 92. That's pretty good. If they get 6%, it's going to last them till 100 years old. But if they get 7%, they literally die with the same $1 million, actually a little bit more, as you can see. So they literally die with more money than they started with. And that's the difference from 1% extra to 2% extra to these different variances in between. None of these things are going to be perfectly equatable to your situation because everybody's different. But what if it wasn't 1.57? What if it was 0.57 or 0.25? What if it was a quarter point extra? Those things all add up and they can make a big, big difference. And so I would ask you, what does a financial advisor cost anyway? Now, I'll be honest, probably 9 out of 10 financial advisors, planners, they don't have the capability to do this. They don't have the desire to do this. It's just not the type of planning they do. They sell products. But what if an advisor could add 1.57 to 3%? Or, some factor thereof? Would it be worth it for you to hire the right advisor? The question or the point there is the right advisor. But let's just say, what does an advisor cost? What does a professional planner cost who does these things? And let's say you're paying 1% on $1 million. No, that's not our fees. But let's just say for ease, you're paying 1% on $1 million. and that advisor added 1.25%. So you're up 0.25. What if they added 2%? So you're up 1%. What if they added 3? What if they took you from that 5% to the 7% and now you die with a legacy versus die with who knows what? Is that worth it? So I'll ask you another question. For you to be a successful investor, you have to have 3 things. Very, very important. You have to have the time not only to manage, monitor, control, asset locate, asset rebalance, but you have to have the knowledge, what to do, how to do it, when to do it. And that knowledge takes time too. And you have to be consistent in this. It's not just a one-stop thing that you do once every 5 years. You have to be consistent. You have to have the time. You have to have the knowledge. Are you staying up on the tax law? Do you understand what the Secure Act just did? What about the last Tax Cuts and Jobs Act? How did that affect people? What about the rules on Social Security, which changed a few years back? Do you have the knowledge to make sure that you're squeezing every last dime out of your retirement plan? And finally, you have to have the desire. Now, the desire is the easiest one because so many people say, oh, yes, I want to do this. That's great. And I love it and I respect it and that's awesome. But you have to have all 3 to be successful. You can have the desire without the time or the knowledge and you'll still fail. You can have the knowledge without the time or desire and you'll still fail. So a little bit about what we do here. We do basically most everything that I just discussed in the planning process with the Morningstar and the Vanguard studies. We look at all these aspects. We look at Social Security. We look at Medicare. We look at your tax projections. We look at Roth conversions. We plan and map out your retirement lifetime. And they're just things that we do every day for people. And so that's a little bit different from what most other advisors do. Most importantly, we hold ourselves accountable to you. I'm going to throw out a concept to you, and I'm going to ask you, have you ever heard of a financial advisor giving you a report card on their work? Because that's what we do. Once a year, a client comes in. We've developed a client report card. We talk about how many tax planning, things did we do behind the scenes or with you? How many events did we hold, educational events and in-person events? How many times did we meet? How many times did we call you? How many times did we reach out to make sure that your taxes, you don't need anything else to file your taxes? This is a client service report card that we give to you. We hold ourselves accountable. So I don't know. How do you grade your financial advisor? Is it gut feeling? Are they adding the value or did they sell you a product? Are they adding that 1.57 to 3%? Or are they just selling you things? So these are things to think about. So these 2 studies, they're widely available online. You can Google them pretty easy. You can download them. Add up those 7 different things from Vanguard. You'll see that they say it's about a 3% bump in your results. Add up the Morningstar one, about 1.57%. We've talked about asset location and asset allocation and rebalancing and withdrawal sourcing and Roth conversions. We talk about all these things. But it's worthless unless you go out and do it. So I want you to go out and read these studies. I want you to go out and do these things because I want you to add that 1 or 2 or 3% per year to your bottom line. And again, it's not going to show up in your investment performance. I mean, there may be small parts of that. We could have another discussion on that. But it's not necessarily going to show up on your investment performance. It's going to show up in your tax return 3 or 5 or 10 years down the road. It's going to show up in your Social Security when you've maximized it and you've actually made the right decision versus just taking it at 62. You've got to coordinate these benefits. You've got to coordinate these income streams. You've got to build them all into this retirement comprehensive plan. And most importantly, it's got to deliver the memorable and the purposeful retirement that you've always dreamed of. And that's great, but it's got to do it with massive money confidence. So anyways, thank you so much for attending today. It's been a pleasure. As you can tell, I eat, sleep, and breathe this stuff. It's kind of fun for me. If you have questions, reach out. You can go ahead and real quickly, you can download those reports and get a little special bonus. And stay tuned. I will be doing more webinars on various topics like Social Security, Medicare, IRA planning, taxes. So stay tuned. Thank you very much. This is Greg Phelps, Red Rock Wealth Management here in Las Vegas. My social media, my blog, my educational component is RetireWire. Check it out and have a great rest of your day.